Hi, my name is Saul Simon, and periodically I receive requests to share some educational information about some of the problems that are happening when it comes to tax law changes or various tax implications. Today's session is about qualified assets. The US government has taught us to save money on a tax-deductible basis using IRAs, using 401k plans, using profit-sharing plans, using defined benefit or cash balance type of retirement plans that many business owners may have available. And some of my clients and maybe a viewer could have a significant amount of money in their retirement asset. And frankly, it's a very, very bad asset to die with because of the recent tax law changes and the inability of having this money be dispersed over a child or grandchild's lifetime. Um, so let's go through some compliance information. Saul Simon, certified financial planner in the business 40 years. I'm a fiduciary. I love educating people, and I'm a resource. Um, there's a tax time bomb sitting inside of your IRA 401k plan. The 10-year rule under the Secure Act recently changed um, inheritance forever. Bad money versus good money. Redefining what your assets are really worth and what they're going to um, ultimately pass on to the children and grandchildren, given you, me, we have worked so hard for these assets. I'm going to share a repositioning strategy. I'm going to share some example of some numbers. And then the question is this right for you? I don't know. If you want to have a phone call, if you want to do an analysis, it's my pleasure to offer you some choices, some options. Let's see. So, you've made contributions to these tax deductible accounts, and you've had these assets defer, defer, defer. The money's growing compounded, tax deferred for 30, 40 years. When I take a distribution on tax deductible dollars, every dollar that is withdrawn is taxed at ordinary income. And, you know, we're sitting on a very significant deficit. The world outside of my office is volatile, and there's always changes happening. There's always incidents to cause the markets to have fluctuation, including the tax law. And then the death and transfer tax. Um, Not only is there an estate tax and possibly a federal estate tax and a state estate tax, but also an income tax on all these dollars that are going to come out. Um, so at age 73, according to the Secure Act 2.0, you are now required to take distributions out of your retirement account valued on the prior 12/31 date, um, December 31 date. Um, Top ordinary tax rate at 37%. There could be also state tax. And let's use an example of $3 million. The Secure Act says that my money must be distributed over 10 years. So, what's that mean? Well, I'm married, I die, it goes to my spouse. She continues the deferral. The second spouse, or maybe you're single, which means ultimately the kids or grandchildren are going to receive the inheritance. And upon their receipt of this money, they now have, by the law, they must take distributions out and completed at the end of 10 years. So they want to take out money on a monthly basis. They want to take out money annually. It's all taxable income in their tax bracket. A lot of our kids are doing well. Also, a big tax implication. And at the end of 10 years, this account has to be exhausted. The kids want, the government wants the money. That's what they want. They want the tax. Um, Prior to 2020, beneficiaries were able to spread their distributions out over their entire lifetime. So, you make a grandchild 10% of your beneficiary, and they could defer that for the next 60 years. Granted, they have to take a small RMD, required minimum distribution, out of that account, but it was a very, very tax advantageous planning tool for deferred growth and then tax distribution. A 30-year-old child could stretch it out over 50 years, dramatically reduce the annual tax exposure per heir, wealth compounded, the magic of compounding over decades. And it was a powerful multi-generational wealth transfer tool. Unfortunately, that tool has now ceased. So what's this 10-year rule? Well, a non-spouse, children, grandchildren, must drain the entire account within 10 years, no exceptions. It's forced distributions, probably at the kids' peak earning years. The income is stacked on top of the salary that your children or grandchildren are receiving. And in this case, a $3 million IRA could literally cost the kids $1 million in income taxes. So here's a scenario. Your child, age 45, inherits $3 million. They earn $180,000 a year. 300,000 is a minimum forced annual distribution. 37, 40% tax, estimated tax $1.1 million to the IRS, which meant you've worked real hard. You've had monies growing on a deferred basis for a long, long, long time because of the rules, which were good planning at the time. And ultimately, the family is getting a net 1.9 million because we're given $1 million plus over to the IRS. Bad money versus good money. So not all assets on your balance sheet are equal. So this is some education, and we could, briefly speak to this. So again, the qualified assets, there's a deferred tax liability embedded in every dollar. 100% of the money is taxed as ordinary income upon withdrawal. RMDs begin at 73, taxable whether you need it or not. Your heirs face a 10-year forced liquidation and heavy taxes. And the IRS is receiving this taxation on this account within 10 years. Good money. Let's talk about life insurance. It's a product, it's a tool. This is a choice. This also opens the door for a very wise conversation with regards to converting to a Roth. I use this example as I look at products as financial tools, and I'm using life insurance as a financial tool in this scenario. Life insurance, it grows tax deferred. Any cash inside the policy is deferred. You have the ability to access income tax-free via policy loans. The taxation on life insurance cash value is FIFO, first in, first out, because all these monies I pay into an insurance policy have already been taxed. No RMDs are required, required minimum distribution, not applicable. Death benefit, it passes income tax free to the beneficiaries, and that's under Section 101 of the tax code. And if it's important, if we want to have this conversation, it's my pleasure to offer you this education, is it can also be passed on federal and estate tax-free for generations. So let's just, go through this a minute. You get to control the distribution. So we take planned strategic withdrawals from your IRA, ideally, if we can, in lower tax years, before RMDs force a larger tax consequence. So we'd want to do a little planning, depending on your age, to look at the disbursement of what's the ideal time frame and maybe even a time period to take these disbursements. Two, pay tax once on your terms. Like you get to choose this. Three, let's fund a life insurance policy. Let's use these after-tax dollars, reposition into a permanent cash value type of a product. And frankly, because all I'm looking for is the death benefit, I've been structuring these almost like a decreasing term insurance policy because I'm not necessarily looking to build cash value. I'm looking for the tax-free proceeds to replace the tax time bomb on all your qualified money. And if not all, a portion of it. And all this will pass on income tax-free and possibly estate tax-free. Should you need access, some people want to control and have access to this money. You have full access to this money, and there's no taxation as long as we do this properly. And again, the death benefit transfers tax-free to your beneficiaries, which is pretty powerful. All right, let's keep going. Permanent life insurance. Cash values accumulate inside the policy, gross tax deferred, similar to like an IRA, right? Except the taxation is really different, and there's no forced distributions. You have access to take out policy loans and withdrawals, income tax free, without RMDs, without tax 1099, no tax distribution, as long as we do it the right way. I've been doing this 40 years. You have a death benefit. We're looking to guarantee the death benefit. So we want to structure this product and choose the right product so it produces the result we want. There's no 10-year rule. We don't have to worry about taking distributions out. There's no forced liquidation. We could structure this so that it's estate tax free using an irrevocable life insurance trust. Irrevocable, meaning we have to name a trustee to help manage what's owned by the irrevocable trust. A trust, real quick, is a shoebox. There's shoestrings outside the shoebox. If we own, in this example, life insurance, we put the lid on it, we put the shoestrings inside of it. You can't touch it. And because you can't touch it, control it, access it, it's now out of your estate and it's estate tax free. Real quick, revocable, meaning the shoebox has the lid off. There's shoestrings, you can touch them. Hopefully, if you're a resident, for example, in Florida, as I am, you want to absolutely have your home, your non-qualified money, your bank accounts owned by the revocable trust so that you're bypassing probate. Because in Florida, you're talking about a 5% probate fee on $1 million, that's 50,000. Compound that out over 10 years, you're talking a significant amount of growth and loss of an asset. And you worked real hard for your money. And A lot of people I'm talking to, have net worths of $10 million. So 5% on 10 million, it's a lot of an expense, the numbers. Again, here's an example. It's just an example. Um, Susan and Robert, ages 62 and 60, they have a $4 million IRA, 120,000 of other income coming in, a couple adult children, do nothing. I got to take distributions out at 73, 146,000 fully taxable, paying income taxes at $500,000. The IRA, using a pretty, conservative type of a growth rate, is worth, 4 million. Children inherit under the 10-year rule. They're paying about 1.5 million in income taxes, and the family's inheritance nets down to 2.7. So, I read a book called Die with Zero. And the concept is, I'm trying to think of the author's name. The concept is, if I knew the day that I was going to die, maybe I would want to give my children, give my grandchildren, create charitable trusts or foundations where you could actually see the benefactors enjoy and get value from the money that you work so hard for. Um, I understand we like our children, we love our grandchildren, and very often, many people really want to know that they have financial independence. So by putting together a bit of a financial plan, a financial independence model, lets you, me, us to see using conservative rates of return for growth, using distribution strategies, coming up with plans, suggestions, choices as to how can we use these various products as financial tools that ultimately at the end of 20 years produce a result that you would like to have happen and be able to pass the hard. You've worked so hard. We've all worked so hard to accumulate what we've done to be able to pass it on to our family. Let's reposition. Let's use this distribution strategy. We distribute 150,000, and we do that over 6 years, 62 to 68, paying maybe a 25% tax rate. We're repositioning money, and we paid $263,000. We fund 900,000 into this insurance product. We have a guaranteed death benefit of $2.8 million. The remaining IRA is reduced, RMDs and taxes are lowered, and the net family inheritance becomes $4.4 million tax-free. This is just a suggestion, an alternative. There's no free lunch in life, but frankly, wouldn't you rather give the kids more money and ultimately give the IRS less? Hello? Um, and when you educate someone, and I act as a resource to share these things, people get value and people appreciate, the education. And that's what we do. And I've been doing this for 40 years. So you do nothing, 4.2 mil income taxes that your family, your heirs are paying is 1.5 million, net to family 2.7, 37% hit. Repositioning as a strategy, a thought, 3.1 million, we reposition. Your heirs pay $100,000 in tax. The family receives 4.4 million tax free. It's a 3% loss. Bupkis. Um, you don't like life insurance. You don't want to spend and look at, oh, it's expensive at my age. I'm using scenarios to show you you're repositioning earnings. You're repositioning assets so that they're beneficial and able to pass more wealth on to the family. Is it right for you? I don't know. Let's have a conversation and see if it has an impact and can mean something. 3 million or more in IRA assets, qualified money. Um, you need to be in good health. Very often, I do have um, creative ideas to help us to obtain insurance. And we also have the ability to not only insure you, but if you're married, we can insure, quote, a husband and wife. And then also, frankly, do you want to transfer money to your heirs and give money and less money to the IRS? That's also an important factor. Do you need every IRA dollar to meet your current living expenses? What do you have extra? Um, is there a window, maybe a powerful opportunity before the age of 73 to take advantage of this technique, this strategy? And are you concerned about taxes? Do you think over time our income taxes are going to stay the same, go up, or go down? Which could make this scenario a little different. The national debt exceeds $36 trillion. Where are they getting the money from, except maybe income taxes? Um, tax provisions are scheduled to sunset. Uh, Many of them are set to expire. And I don't know how and what they're going to do to pass them or edit them and amend them. Every year you delay, it's just making this tax possibly be higher, and ultimately leaving the kids with less of what you have worked so hard for. And then, as you may know, as we get older, the cost of insurance increases, and it's possible that our insurability can change. So if you have questions, you want to talk about it, let's set up a call. Um, I'm offering this analysis, this review, to show you, do you have financial independence? To show you, what if we repositioned money and did a conversion into a Roth, and or would it make sense for us to look at this product called life insurance as a financial tool to see if it actually could be appropriate and beneficial to you and your family? And this way we can determine, do we do nothing or would it make sense to reposition? Um, I love educating people. I've been doing this business for a long time. I love what I do. Very fortunate and blessed. And I appreciate everyone that takes me into their confidence. Anything we talk about is confidential. Um, and I appreciate your input. If you have any questions, give me a shout, or send me an email at saul@saulsimon.com. We'll put the information on the back. And I wish you a wonderful day. And thanks very much. Bye-bye.